being in Los Angeles, just tend to play a completely different game. It's not an LA only approach, but if you look at what's going on down here within deep tech space, gaming, consumer with folks like Tinder and Snap, like those networks, it's pretty clear there's huge venture scale companies and networks that really matter. So like the SpaceX network, like those people aren't just leaving Los Angeles and moving to the Bay Area to start the next company. Same with Anduril, or you can kind of go down this line of folks within that sector. The same is true for consumer. There's also a ton of VCs who live here and don't talk about it on Twitter, which I'll say. And so
do you want to call them out?
No, I'll leave that out of the podcast, but it's like the opposite of the Miami approach to like ecosystem building, where I think it's a little bit more low key here.
Welcome to Sorcery. I'm your host, Molly O'Shea, founder of Sorcery. Today, we have Jeff Morris Jr., GP of Chapter 1, a product-driven early-stage venture fund based in LA. Chapter 1 is backed by Sindona Capital, Sequoia, Kleiner Perkins, and Mark Andreessen. Jeff is particularly known as one of the best product leaders in the industry and previously served as the VP of Product, Revenue, and an early employee at Tinder. In the role, he led the revenue team to the number one top grossing app in the App Store. He managed the business from the early days of monetization through the IPO and for several years as a public company. Jeff is a seed investor in 13 unicorns, including Mercury, Supabase, and Compound Finance. We go deep into Jeff's opinions on the current climate for emerging managers, as well as how he runs Chapter 1 as a product-oriented venture fund. This is a fun conversation, and I think you'll enjoy. Hey, Jeff, thanks for joining us.
Hey, Molly. Great to be here on a Friday.
So to start, I want to dig into something that was pretty juicy. You tweeted out back in May. You mentioned writing an article about emerging fund consolidation. In this tweet, you bucketed out into like 3 different items. So you said this could entail merging with other emerging funds, merging with other large platforms, and well, shutting down. So based on that and the time between it all, where are you at with the article and what gave you inklings of this potential behavior?
Yeah, I kind of put it out there. Like sometimes I'll tweet things to see if there's general interest, like kind of like MVPing and the idea of writing an article by just tweeting it out. And if people are interested enough, I'll actually write the article. But the general idea was that, I'm hanging out with emerging managers all day long, and what's happening kind of in background conversations, I think, is a lot of uncertainty that the market, I think, generally knows there will be a shakeup. Like that's pretty obvious at this point, but the extent of what that might look like, and also the options for GPs, I think, are things that people should talk more about. And that if we were to speak as freely about venture funds as we do startups, and view that conversation as being okay, that I think it would help LPs and GPs understand the dynamics heading into not only 2024, but kind of like the next cycle of venture capital, because it's pretty clear like the world's changed quite a bit. And so I think since I tweeted that article, there's been, even the past 2 weeks, some pretty interesting ideas that have come out. One was Josh Wolf at Lux Capital wrote his quarterly letter, and he predicted that 30 to 50% of venture firms would cease to exist. And then Rick Zullo at Equal Ventures, who's a friend, wrote a follow-on to that, exploring the same idea. And so in terms of where I am with the article, I'm making a ton of progress. So in the past week, had a conversation with Beezer at Sapphire, and she gave some really interesting perspectives. And then John Felix, who's been a long-time LP, most recently at Allocate, we had a similar call about a week ago. And how I want to frame this is not in a scary way. Like I think the natural idea, like when people tweet these things, I think there's like a feeling of fear. I think there's an element of discussion that can lead to creative outcomes, and also hopefully more creative pitches from GPs, because I think GPs are now being forced to answer a lot of really hard questions about why they should exist in a really crowded market. And that's led to, I think, just sharper products for founders and LPs. So Yeah, it's a really interesting topic. Honestly, like so different from what the conversation was in 2021 and 2019 when I started chapter one. But I feel like we've all been through many market cycles at this point. This is just like the current state of the market.
Can you share any of the highlights from your conversations with Beezer?
Yeah, I think she did a really great job of like trying to distinguish, like there's so many venture funds, and so you can think of just like one really easy way to draw a line would be venture funds that have raised institutional capital and have like that level of backing. And generally speaking, those funds tend to be a bit more insulated from potential shutdowns, just based on the idea that that capital is a bit more sticky and dependable through different market cycles. Not to say that institutional LPs don't have their own liquidity challenges and are definitely kind of starting to see some churn amongst LP bases that I'm hearing in the background, institutional LPs who are not re-upping in some cases, but there's that group. So if you were an emerging manager, say 2019 through 21, and you have endowments or universities or pension funds, whatever it might be, as your backers, like you're probably in a better position today than a lot of managers who I think maybe they weren't ready for that, or maybe they didn't spend the time to go through that process. But whether you raise a rolling fund or you have high net worths or family offices, or a lot of sub $30 million funds, I think we're able to stitch together LP capital in non-institutional ways. And I think that's tough because you're having to go back to those folks, and maybe you're on a fund three or raising a fund three with limited DPI. And the reality of it is like those folks are just less dedicated to the space through every market cycle and have their own liquidity challenges, which is very real. And so I think that contraction will see a greater percent of those funds go out of business. But if you have institutional backers, you're in a better position today.
Got it. And maybe before we dive into some more questions on this, it would be good to define what an emerging manager is. So do you mean emerging manager by the size of the fund, by how many years, the vintage? How are you defining it?
Yeah, it's actually a really good question because I don't think there's an industry definition. I kind of think of it as being personally just like without applying too many guardrails, think of it as being a fund that was started in the last 5 years that's probably on their second to third fund. There's better definitions, to be clear. And so I've heard, I think it was Roger Ehrenberg defined it as any fund that's returned 1x DPI on all capital they've raised to date. And so you stop being an emerging manager when you actually return every single dollar you've raised, you distribute back to your LPs, and then you've graduated from emerging manager status. I don't know if that definition is what everyone thinks of, but it was just a way to apply some metrics to the idea. But I think for me, it's a newer venture fund that has come to market in the past 5 years that's trying to become franchise. And so ultimately, I think that's the goal if you're starting a firm, is to really build a sustainable franchise. And there's some point where that becomes a reality. And until you find that level of kind of business stability through your LP base and through kind of that foundation, you're not quite there as a franchise.
That's a really good definition, actually. I don't think I've heard that kind of explanation before. I want to dig into a number of things based off of the tweet. So what are the current conditions for emerging managers?
Yeah, I mean, I think it depends, but for the most part, ask on the LP side, generally speaking, is they want to see DPI. That's just no longer do you walk into a pitch meeting and show your multiple uninvested capital or even TVPI. You have to just show DPI and be really clear what that number is. And I think the reality is for most emerging managers in, call it fund 2 or 3, if you just look at the M&A market and IPOs, there's not obvious solutions for the DPI challenge today outside of secondary markets, which are, again, you're taking probably a 40% discount as a baseline on your positions to show DPI. So I think a lot of emerging managers are kind of caught in this market cycle where they're in their teenage years as venture funds, these awkward teenage years, and they're just waiting for DPI. And that can come in different ways, but that's ultimately the real unlock there just needs to be an IPO window or an IPO market that's more healthy, and a less restrictive M&A market, because also the regulatory constraints on M&A right now are obviously a blocker to allow that. There are emerging managers who are coming to market with new funds, so call it like a 2023 plus emerging manager, who I think has the benefit of not getting caught up in what's been a really challenging market cycle. And so if you're just starting a fund today and you're spinning out of a larger venture platform or graduating from a really relevant founder network, you might have a good story to tell, and you can also kind of shape your product around all of the, I guess, missteps of venture emerging managers from the last vintage. So there's kind of like a shiny new product element to raising a fund one that I've seen some GPs benefit from. If you're just a newer investor or less proven track record and your story is not super compelling, it's going to be remarkably hard to raise a fund one, which I think is healthy, but ultimately like it's hard. And so I think I get a lot of emails and phone calls from people just trying to ask like the very basic questions of how to raise a fund one. And I'm pretty honest with most people, if their story is not compelling, like it might not be the best idea. And some of these people likely would be like maybe principals at like a venture platform. I'm also seeing a lot of people spinning out of call them like non-general partners, trying to spin out of larger venture platforms and start their own funds. And that's pretty interesting because a lot of these folks I think are early to mid-career and maybe don't have like that really big outlier success story they can tell. But I think that they feel like they kind of earn the right to raise a first fund because they have some brand name, multi-stage venture name to their resume. Hard to like fully, it's hard to say whether that's a good idea or bad idea. It's very case dependent, but I think smart LPs are able to really dig into attribution and track record and figure out the motivations and the reasons why those folks are starting venture funds. And it can't just be because you didn't make partner at X multi-stage venture fund, because that's not a reason to raise a venture fund. And also probably the part of the market that people haven't talked about too is a lot of the larger venture platforms they're not hiring huge amounts of investors right now. In fact, a lot of folks are leaving those platforms. And so, what do you do if you're mid-career and you're leaving a large venture platform and you didn't make general partner, and maybe you don't have like a ton of operating experience? Like that's a pretty challenging place to be career-wise. And so seeing some examples of that.
Interesting. Yeah. Even I know this wasn't something we were going to discuss, but one of the things that's been a common conversation among friends at other funds and partners and things that I've seen in my day, though I'm not a GP or anything, is partners quitting and like starting to look other places, and like you start to know when it's happening. But no, that's a real thing. Partners leaving large funds and all of that. In terms of the emerging manager funds that are out there that are in a really harsh environment, of the three buckets that you mentioned, consolidating with other emerging GPs, consolidating with larger platforms, and just shutting down. You can be anonymous. You don't have to like share any specific names unless you want to. I'm sure people would love to. But could you share some examples of that, and like if there's been any sort of creative options or what you would actually propose maybe?
Yeah, so I'll just like give some recent examples maybe on the more interesting side of things that I find compelling. And then we can talk historically about things that maybe haven't worked. And again, I credit folks like Beezer who have helped me kind of like market map some of these historical examples. But so the recent examples I think are most interesting would be like Ethan from Bessemer, Christina Shen from Andreessen Horowitz, and Mark Goldberg from Index Ventures leaving those large platforms to form like a real partnership, right? And so those are people who some of them worked together historically, but then they competed against each other and they saw some gap in the market. And rather than going out and raising, like the easy thing to do probably for them would have been to go raise smaller funds as solo GPs, but somehow like the stars aligned and they came together. It's really hard to do. And so that's one version of consolidation is, hey, we're going to leave our large platforms and start something together. The other form of consolidation, which I've mentioned and is more like a more common conversation, again, hard to do, would be emerging managers coming together.
Hey, we'll get right back to the conversation after a word from our sponsor. Sorcery is brought to you by Archer, I'm genuinely amazed at what Archer has been able to accomplish. Archer's goal is to transform urban travel, replacing 60 to 90-minute car commutes with estimated 10 to 20-minute electric air taxi flights. They are safe, sustainable, low noise, and cost competitive with ground transportation. Archer's Midnight is a piloted 4-passenger aircraft designed to perform rapid back-to-back flights with minimal charge time between flights. Learn more about how Archer is set to open up a new world of opportunity for passengers by providing safe and efficient access to people, places, and events across the communities they live. Visit archer.com.
So maybe you have either like a vertically aligned thesis and you think 1 + 1 = 3, or you have very specific verticals that you cover that would make a really compelling partnership. And so we've seen that historically with things like Variant in crypto when Lee joined Variant. I think I've seen that version of conversations. I've been approached so many times to explore that conversation. The reality is it's very hard to make the timing work and to make this story, I guess, to really like find that 1 + 1 = 3 story that would market well to both founders and LPs, but more importantly, that would make your firm better, right? It's just hard. It's hard culturally to do. The examples I think that didn't work historically was, so like there's one point where Social Capital tried to join Kleiner Perkins for a variety of reasons that didn't work. Mamoon ended up joining Kleiner and is now managing the fund. And so they spun out to do that. And then Beezer mentioned Bonfire Ventures, which is a Los Angeles venture fund. It was a consolidation. Mark at Bonfire bit more under the radar, but that was one example. The last example, which is pretty interesting too, would be larger platforms acquiring smaller funds. So they could be vertical specific funds or geographical focused funds. So the kind of the General Catalyst example, acquiring La Familia, was one example of acquiring an international focused fund. Without naming too many names, and this has been less recent, but call it within the past 3 years, we've been approached by at least one major multi-stage platform to be their seed fund, which for a variety of reasons, we just didn't happen. No, timing was really hard. And culture obviously was very hard, but the first thing was timing. We just raised our fund too, and we felt really strongly that we wanted to commit to that and do that really well. Probably would have been candidly like a much easier financial path for me, being like big salary, cushy job, whatever. But we resisted that at that moment in time, although it would have been really interesting. And so kind of examples like that, I think are worth talking about.
That's wild. I don't even know like how that would work. So how would you structure something like that? How do you manage the incentives? Obviously, as a solo GP, you have lots of carry, you have so much opportunity, you have like pretty much like uncapped upside and then face the music one way or another. How would you kind of mesh those incentives together, whether it's compensation or the actual culture and that kind of thing?
Yeah, I think like the long-term solution would be you would just eventually like effectively shut down whatever venture fund was being acquired and be a part of that platform. In terms of where like it would start, it'd be more like, it would look more on the surface like a partnership with some shared carry and upside for the GP who's being acquired within that multi-stage fund's broader platform. So they're all their fund vehicles you'd get exposure to, and you'd be giving up some amount of your carry, probably a significant amount, maybe up to like half your upside to that platform. But I think these were just creative ways for larger platforms to explore expanding their reach and teams. Especially in 2021, there was an arms race to grow amongst multi-stage funds. And I think that was what was driving some of these conversations. But the structural piece is very hard to get right. And I think the harder piece too, if you're managing a existing LP base, would be to go to those LPs and get them really excited about, at least in the current fund, that being a great outcome for them. Because if you're going through some M&A, effectively like an M&A process or some partnership with another venture fund and trying to deploy your fund, like something's probably gonna give. And you might be tempted to deploy that current fund faster to kind of create like a fresh slate or a blank page to pursue like the next thing. And so all these things are considerations. The argument for is like, it's just so hard for emerging managers to stand out. And so if it was the right multi-stage platform, having that partnership in place could really accelerate your path towards being highly relevant and winning deals and kind of becoming like a franchise much faster. And so like why I even like had a conversation or thought that was an interesting idea is like ultimately if your goal is to generate the best returns and work with the best founders, like there are ways to accelerate that potentially. There really aren't a ton of shortcuts to building a venture franchise. Like you have to invest well and return capital over maybe a 10 to 15 year life cycle. And so that if there are any ways to accelerate that, like that can be interesting for a GP and potentially for their LPs too.
It is extremely hard to accelerate something with such a long time horizon of even knowing what the outcomes are. Wow, that's a good point. Okay, so I want to set the stage here. I have some numbers.
Nice. Okay.
I pulled together some data from the NVCA 2023 report. I think they got some of their data from PitchBook. I will share it. But this is quite interesting because I had no idea there were so many funds in existence, and it really swelled in like 2021. Okay, so for some data, by 2023, there are estimated around 7,200 venture funds in existence. The active number of investors swelled in 2021 to over 20K people. And this is a cottage industry. By 2023, it halved to about 11,000. So to be more specific in terms of venture, in 2021, the active number of VCs was around 6,000. Now it's around 4,600. It's still very high, but it's dropping to like pre-COVID levels. The normalized number over the last 10 years pre-COVID was just a little over 2,500 for active global investors, VC investors, and around 2K for US VC investors. Do those numbers sound right to you? Like, given you've been in the industry for quite some time, like, how many calls with investors have you had? Have you noticed some aren't picking up the phone, their email's gone? Like, what are you seeing?
Yeah, I think the reality is like you're still managing when you don't raise your next fund, you're still managing a portfolio. So nobody, and you've seen this with like Shasta Ventures is a good example. Like their website's still up as far as I know, and they're not actively deploying new funds today, but you're still managing a portfolio. And so I haven't seen like firm shutdowns where like literally people's emails aren't going through. I have seen people choose to go down different career paths. So some folks decide to go back to operating and like they'll go get like a really interesting job on their operating side. So you don't have to go through like the public announcement of shutting down a venture fund because it's just kind of like what's next. The numbers do sound right to me. Again, like I think at least like the data I've seen is only 17% of venture funds make it to fund 4. And so if you were just to like build some like Excel waterfall of graduation rates of new funds during that vintage and then kind of map it out to where that consolidation is happening, it would probably line up pretty well. But I don't think, again, the data is very hard to get right because like PitchBook or Crunchbase isn't announcing fund shutdowns. So I don't even know like where that data comes from unless there's like some rule set you would apply like, hey, if you haven't raised a fund in X number of years, call it 5 years, like we'll assume you're done. But this is like very lagging. It's like lagging data sets, right? It's very strange because I don't think we'll ever like see the story reported in its entirety in a accurate way, but there's just it's more directional, I think, at this point.
Yeah. I don't even know how they count the number of active investors. Like, is that related to the fund? Is it for GPs? Is it total headcount of investors on the team?
What was your number that you mentioned?
So the active number of investors in 2021, it was around 6,000 for global and 4,600 for the US.
Got it. It's funny. I don't know. I looked up because I was trying to market size the number of VCs and I'd seen something closer to 50,000, but again, like that could be angel investors, everything
Yeah.
included.
Right.
But yeah, maybe if you were to really look at like venture funds, anybody above, call it like $20 million, 20 or $30 million, it ends up being a much smaller number.
Yeah, yeah, it probably does incorporate angel investors. It's interesting. So if that is the case and those are the numbers, where do you expect it to fall this year and next year? Do you think it'll normalize back down to around, I don't know, let's say like 2K? Like how many funds do we think will exist given some people are taking haircuts of anywhere between 30 to 50 and I've also heard like 70% of funds are going to go away. So
Yeah, I think I kind of go back to what Beezer said in like really emphasize the definition of a venture fund and maybe drawing the line on that institutional side of things. Like, do you have institutional backers? Non-institutional venture funds, I think the majority of them call it, I think that 40% number would be on the lower end of people who I think won't be raising additional funds in the next cycle. And so I don't know exactly where the number will land, but if you don't have institutional LPs, I think it's going to be challenging, or maybe you just have to raise a much smaller fund. There is a certain element of at what point should you just go explore other ideas, because as these really small funds, unless you have some financial cushion, like it becomes a question like, is this like the opportunity cost financially is pretty great if you're doing high upside, obviously, but you have to really, really, really love this job, because if you are just doing it because you think being a venture capitalist is a glamorous job, like at some point it becomes really unglamorous and you have to just love the job. There's some founders, you probably meet this from investing, that literally like the idea of doing anything else with their lives just is not an option. And I'd imagine there'll be some versions of that with the emerging manager group, where maybe they'll get creative. They'll come up with a side hustle. They'll do some like media company or something else to bring. There you go. But you'll come up with different ways to kind of create enough revenue for yourself where you can do either a smaller fund or SPVs. I've seen that too, like fund managers who can't raise next funds leaning more into SPVs. Again, these are hard things to do just on a lifestyle level if you live in a major city where a lot of venture capitalists are expected to live. But if that's what you love to do, there's probably ways to make it happen. The last thing I'll add is a lot of the cohort from 2019, like people are getting older and starting families, like having different lifestyle changes that, again, like it gets harder, and the kind of career risk or the opportunity costs becomes a huge question for, I think, a lot of people.
Yeah, that's a fair point and a big factor too. It is I think like a lot of people forget the financial point of it, because if you raise like a $20-50 million fund, like there's only so much capital left to like actually support yourself, and if you can get a team and that kind of thing after legal fees and all of that sort of stuff. But it's a real factor. I would say, given your experience and some of the research that you've done, you're a founder of a fund, you're a managing partner. What do you think is the biggest limiting factor for fund managers as they grow? Is it sourcing? Is it access to deals? Is it like endurance? What do you think those things are?
So there's a couple of things here, but the markets are so dynamic and technology changes so quickly. I think the biggest challenge for an emerging fund, especially if it's a small team, call like a 1 to 3 person team, is relevance. And so the 2019 fund managers, a lot of, I'm including like everyone in my cohort, brought their funds to market at a very different time in the technology industry, where if you think about the things, like think about the trends that mattered, like the types of companies founders were building, like that's changed pretty dramatically over the past 5 years, and especially the past 2 years. And so, I think the biggest thing is like you can raise venture funds to some degree if you've done a good job and have happy LPs. But if you really dig deep in your soul and ask yourself, like, are we on track to being a top tier venture fund, whatever you're building? You have to be convinced to do this if you want to perform at a high level, that you're on that path. And if you're not, you should make changes to whatever you're doing and iterate your strategy to trying to find that level of product market fit. And so like the biggest question we ask ourselves at Chapter One is just like, what is our product market fit, and do we need to iterate or pivot or change our strategy to get there? And we're very okay doing that as long as we feel like we're qualified to, like, we're the right people to make that adjustment to whatever we're doing. Or do we need to change parts of our team composition to accomplish that? But yeah, so I think that's a long way of saying, like, I think relevance is very hard. If you're Sequoia or name your large, amazing venture platform, like I think you're naturally going to have the ability to kind of persist through those cycles and hire the right people and kind of make those adjustments. If you're an emerging manager and you have limited management fees, like it's just you, maybe two other people. And so it's like, how do you move with industry and stay relevant? I think is the biggest question.
This is so real. And the battle of the brands is also totally real for attracting talent and for attracting founders. Every time I think it's not, it is, unless you're like a silent killer and like, you're just like awesome and like, you can kind of sneak under the radar and get through it. But I think that's a huge factor. That's so right.
Yeah, the silent killers are interesting too. Like that's, I don't know how people do that really well. Like, I mean, a lot of it's like network driven and you're under the radar, but obviously very important within a specific network. It's just, to me, like, not like why I've always been able to win is because people going into a phone call have somehow like figured out who I am from my operating career. Things I've done online, that it makes that conversation like a bit easier. There are silent killers, and so I'm definitely impressed by those people. It's a superpower.
It's an awesome superpower. I don't know how it works, but I'd love to know. Given on this trend of just fund managers, before we start to talk about the solo GP life, I think it's important to talk about like insights and advice, given there's a lot of people in the thick of it. What do you think that fund managers think they need to do versus what do you think they actually might not have to do or change at all within their fund or thesis? Maybe this is an extension to the relevance point, but I'm just really curious, like, what do you think is like actually necessary and what do you think is garbage and people spend too much energy on?
Yeah, I think people aren't introspective enough in trying to figure out what makes them uniquely different within our industry. And there's a temptation to just like open up your computer and try and like pound through the day with the most number of articles, the most number of tweets, and the most founder calls, or trying to source as many LPs as possible. What's, I think, really important right now is to ask yourself like the deep existential questions around why you should exist within this industry and what makes your product uniquely different from everybody else's. And if you can't answer that question, then you need to go back to the drawing board until that's answered, because I think what we've seen is just a lot of like sameness and similar strategies amongst emerging managers based on, I think, probably like things that mattered in 2019 that don't matter as much today. And so I kind of think of every fund as being like a new record that you're releasing, and like your next record better not suck, because we all know what happens to musicians when they release a bad album. It's okay to evolve and hopefully not entirely reinvent yourself, but it's okay to evolve and try different things with each fund. And in fact, I'd say if you're not evolving, like, you're probably not doing a great job. So again, I think, that's where I think having institutional LPs helps, who have seen your journey and are close advisors, whether it's an LPAC or whatever else it might be, so that evolution doesn't feel so random to the entire market. But yeah, so I would challenge emerging managers to slow down and really kind of think about what they're doing and what product they're trying to build, and try and answer that really hard question of why you deserve to exist. Because again, I equate emerging managers and emerging funds a lot to startups. And what happens if you're a startup and you don't find product market fit is you go out of business, right? Like, that's just what happens. I think there's an assumption amongst VCs that just because you've been doing something for a certain number of years that you deserve to keep doing it again and again. When we tell all of our founders, like at board meetings or when they're pitching us, we challenge them on their growth or evolution, like their product market fit, but we don't do that to ourselves, which is kind of an interesting dynamic that I think needs to change.
Hopefully, VCs have the capacity to be more introspective. Sometimes it's all ego.
Well, if you're not, the market will force you to be introspective because you're probably not going to be able to raise your next fund.
Totally. Okay, so to go to the solo GP ride and fund managers question. You've mentioned it's not glamorous. It's not it's not all coffee chats and nice first class seats to Singapore. I have no idea where you would go, but it's actually really hard work and it's continuous and it might not actually be what you expect. So I also love the fact that you're just like open about sharing that your fund was also kind of poached by a larger manager and you just said no, even though it's very hard. Okay, so given that, could you just bucket out how you spend your time as a solo GP emerging manager?
Yeah, I think it again, there's like emerging managers who have teams and there's emerging managers who are literally just themselves and like a fund admin. I spent the first couple of years of my kind of career split between fundraising and trying to find great opportunities. I think our fund one, like I raised my fund one to be a $3 to $5 million fund while I was still an operator at Tinder. And so like being completely transparent, like I didn't have like huge long-term ambitions for what I was doing other than like I knew I really loved investing and thought that I could like had a reason I thought I should start a venture fund, but there wasn't like this grand master plan. And so I was like very happy when I raised. It's funny, I talked to these managers today and they're like I want to start a venture fund. Like I'm so stressed about fundraising. I'm like, well, how far along are you? And they're like, I've already raised $5 million or $10 million. I'm like, well, you already beat my fund one, at least the initial like idea of it. We end up raising a bit more, but I don't know why every manager like starts, they want to raise like the $50 million fund one or $30 million fund one. So yeah, in fund one, I actually didn't spend a ton of time fundraising because I was okay with a smaller fundraise as a proof of concept to get to market. And then fund two, we had enough success where in the fund one portfolio, at least early signal that the fund two fundraise was relatively fast. I'll also give like the market credit. We're in a much better fundraising environment today. And I think where more emerging managers are spending time is fundraising. And the challenge becomes you have to, especially if you manage a team, like you have your team, you have your portfolio, and you have your LPs and new LPs. And so you want to make sure that fundraising bucket doesn't become a drag on everything else. Although like fundraising as a manager is required to stay in business. And so we're pretty far along in our current fundraise, which is fortunate. But probably for the past couple quarters, like it's been more time on the fundraising side than some of the team building side. And so I give a lot of credit to my team. Like they haven't always had like the level of collaboration over the past couple of quarters that maybe they would historically. And then we take the approach, we're not a high volume investment strategy. Like we really only do one or two investments per quarter. And so I'm a lot more targeted with the things I want to invest in and try and only do like 1 to 2 new investments per year at this point that I think will really matter and that's helped me. Where in fund one, which was more of an access fund, like it felt like we were doing like a new investment every 2 weeks. And it was really like a very different game of like getting into the hottest rounds. And I kind of like, again, evolution, decided that wasn't how I wanted to approach my venture career. But yeah, so I think it's a pretty good breakdown though.
Is there anything you wish you could do more of?
Yeah, I think we're doing it a little bit more on the incubation side and building side. And again, our like ethos and really the spirit of the fund has always been, we call ourselves a product fund. And so it's kind of replacing the word venture with product and saying, hey, like we came at this from a world of trying to build a better product for founders. And also all of us come from product and data science backgrounds, and our like what makes us happy is, in addition to investing, is like a part of our day just needs to be building software and building applications. So we're incubating 2 companies right now, which is awesome. And then we build a lot of internal software. And so we've built probably like 10 like real products internally that make our lives easier across every category of fund management. So sourcing, underwriting, supporting companies that we use every day. And so Jameson on our team was a former data scientist at Twitter. And she's like a complete machine at just coming up with ideas and building them. And she's in London. So I wake up in the morning and she's like building really, really incredible applications. And I just wake up and they're like built. And so like this week we built two pieces of software that are really awesome. And that's just like 1 week, right? One of them you might find interesting, actually.
What is it?
We built a tool because all day long, like we're sharing podcasts with each other and we don't have enough hours in the day to listen to every podcast. And so Jameson built a really interesting product where you wake up in the morning, every podcast we want to listen to. She found some open source model on Hugging Face that just analyzes the podcast and provides a summary of that we wake up to every day. So we don't actually have to listen to every podcast, but we were able to consume that information and become smarter. So it's using large language models to summarize our favorite podcasts, which is pretty cool.
That's sick. Can I be a beta user? Like, how do I get in on this?
Yeah, I kind of joked to Jameson, like we should just release it. So like our whole, or what we want to do for marketing is not to be writing the most tweets. It's just to release software and products and be, again, like the question of relevance. It's like, nobody cares what you did 5 years ago. Like, which is, like I say that with a lot of self-awareness, like the fact that you worked at Twitter or Tinder or wherever else, like that starts to matter less and less over time. What matters is like, what are you building today? And are you aware of like the latest tooling and what's going on? And are you building things that people today find cool? And so that was something we've come together and talked about a lot, is like, hey, it's awesome that we helped build these large consumer companies, but like stop talking about it and go build the next thing, right? And it doesn't have to be like a huge public company. It's just like little projects that keep you sharp and keep you top of mind.
That's so fun. Are you guys going to be doing like a product launch every quarter, every month? What are your ideas?
So one of them that I'm working on is very specific for the venture capital community. And we're funding it off our balance sheet currently and not approaching it like a venture scale idea at all, which is pretty fun. And we'll probably hopefully release that like end of this year or Q1. The second idea is going to be a venture scale company. And it's without saying too much, it's within the dating category. And so we, again, feel like we're like uniquely qualified to do this. But we think when we announce it, we think this is going to be like global, like it'll be a global news story based on the concept, but we're kind of keeping it under wraps for the time. Because I'm aware that there's a lot of pieces that have come together that could end up like preventing us from doing this publicly. And so we're just kind of crossing our fingers, hoping that things continue to move in the right direction.
Okay. Well, I'm going to figure out what this is because that sounds super interesting. It would be really cool, like, if you guys, I don't know if this is still a cool thing, actually. So, like, let's redact this if it's not. But if you like prompted out different kind of products to make, or if you like put out a half-baked product and see if you could like get a really good engineering team to finish it.
If people can do it, yeah. No, I think so I had a pitch today before this call, and it was an idea. We have a 15-page spec for the idea. We tried to incubate it, and then it didn't find the right team to do it with us. And the founders were pitching me the idea that we had spec'd out, and they were like, it was incredible because it was like every part of the conversation was like very forward thinking on the idea that they were pitching us, right? And so I actually think like whether it's sharing like a product spec or a half built product, like that can attract the right founders to you in a really positive way. And so yeah, I'm thinking more about that. Like we try and share as much as we can. There's some things we keep internal because we think it's like gives us an edge on finding great companies. But for the most part, like we're very much an open book, and we try to like happy to share as much as we can. In fact, like the team I just spoke to, I think I'm just going to probably send them like the whole 15-page spec and be like, hey, here's like our version of a 5-year roadmap. What do you think? Because why not? It's like, end of the day, like we're venture capitalists. We're not trying to build that company on our own because that's not our job. So you might as well like see if there's a good fit that way.
Build in public. Since we're on the product topic, so we're just about wrapping up. But since we're on the product topic, what advice do you have to teams right now that are having a hard time either selling, finding product market fit? Like, what are your principles for product development?
Yeah, I mean, I think it varies by consumer or enterprise. Like, obviously, the consumer building process is more like a Hollywood movie where you know pretty well in opening weekend, like how well a film will do. In fact, you know way before that in some cases because you do screenings and you test it out. The only reason I mention this is because I went to film school and my brain still unfortunately thinks in entertainment terms sometimes. But if you launch a consumer product and it doesn't work within the first few iterations, it's usually best to completely break your product apart and try something new. And so probably like the best example in our current portfolio is Captions AI. And that was their third like pretty big company idea that they were able to build within a very short period of time. And I think that's because Gaurav literally ran the experiments team at Snap and had built dozens of internal projects that he had that muscle memory or that career experience where he's like, release, that didn't work, throw it away. And I see a lot of consumer founders who don't understand that. And it's really hard to kind of like say in the right way, like you should throw that away and do something else. On the B2B side, like I think it's a game right now, again, like staying relevant in B2B software or AI, especially now, is super hard. And so we've seen a lot of teams get really excited about revenue because there's been this pull forward effect of like everybody wanting to bring AI to their enterprise or team. But we're seeing a lot of teams get stuck in like the $1 to $3 million ARR range. And that's harder because now you have customers and revenue and you don't have like the freedom to just completely like walk away from those relationships. So again, I think the game is changing a lot on the enterprise side and B2B side, which will be interesting. I also think I would say there's been a real shift away from software in venture circles that we think is an overreaction to what's going on in AI, where like Chamath has this idea of like replacing, I forget what you call it, but it's like replacing 90% of SaaS companies with, you might know that the concept better, but it's this idea that you can just like with small teams, like build the next, I don't know, Slack replacement or something else. And I kind of take the other side of that and say, hey, if you get within these like deep vertical workflows and very industry specific, software will persist, and ultimately it's hard to compete with if you're just trying to use large language models or code generators to try and compete. Like I still think software is going to be a great category to spend time in.
That's fantastic. I hope so too.
We all hope so.
So we're going to end with LA. Jeff, How did you end up growing the fund in LA, and what's your bull case for venture here?
Yeah, it was all like kind of not an accident, but it wasn't like, hey, we want to build an LA venture fund. I had moved on here in 2015 when I joined Tinder, and we started the fund in 2019. I was very close to moving back to the Bay Area because I grew up in the Menlo Park area, spent a lot of time in San Francisco as an operator. 2021 happened, and it was pretty clear that you didn't need to move back. And we built our team actually more distributed. So I have an investor in London as part of our team, New York. So we're actually not a full LA venture fund. Why do I like to be here? Because I always like to be slightly outside the bubble. I grew up in the Bay Area, so I go up there a lot. My family still lives there. But I think it's really healthy to be in like the second or third market and still be a plane ride away, because if 2/3 of VCs live in the Bay Area, you kind of see, at least I see a lot of them competing for the same things, and being in Los Angeles, like I just tend to like play a completely different game. it's not an LA only approach, but if you look at what's going on down here within deep tech space, gaming, consumer with folks like Tinder and Snap, like those networks, it's pretty clear there's huge venture scale companies and networks that really matter. So like the SpaceX network, like those people aren't just leaving Los Angeles and moving to the Bay Area to start the next company. Same with Anduril, or you can kind of go down this line of folks within that sector. The same is true for consumer. So if consumer matters in any form, like I still think a lot of the best consumer founders are in Los Angeles. You could probably say the same about gaming, which fits within consumer, but you kind of get the point. There's also a ton of VCs who live here and don't talk about it on Twitter, which I'll say. And so
do you want to call them out?
I'll leave that out of the podcast, but it's like the opposite of the Miami approach to like ecosystem building, where I think it's a little bit more low key here. But yeah, I'd be curious like if that aligns at all with why you love being, or why you believe that LA is a relevant place to build a venture career.
No, I think that aligns. I spent 7 years in New York, and I did like 2 5-month stints in Miami. And I go back to Miami pretty frequently. And being in LA, I came out here to work for Upfront, and I loved it. I loved the access to the Bay Area and the fact that you can actually think clearly. You're not caught up in the mix of like YC group chats and like competing with people on like things that you might not even be interested in investing in, but just because it's like in your group chat or something like that. Like I see a lot more groupthink, and like I think it was like Trey Stevens is like wrote a piece on sheep behavior.
Yeah.
So I think you see like a lot more of that up there. That's not to say like it's a bad place to be or invest. Like you can clearly grow like great career and network up there. But I like to visit. I like to visit and go there and get all the energy and come back.
Yeah. I think as an emerging manager, it's probably easier to be in the Bay Area from like a LP comfort perspective, where if you have San Francisco zip code or like that is some like filter for network, which I think can create a bit more comfort for those folks.
Yeah.
Which I totally understand. Like as I mentioned, like literally my parents and everybody from my high school, a lot of, like everyone lives up there, and I go up there and spend a ton of time there and I see that. But again, there are like three investors who really I admire who have built great funds. Roger Ehrenberg from IA Ventures, Fred Wilson from USV, and Josh Koppelman from First Round. And none of them lived full time in the Bay Area when they were building those really iconic venture funds. Like if you think of IA, USV, First Round, that's not to say if you actually talk to those folks or talk to like Josh was in San Francisco. I think someone told me he was on like 50 plane flights a year, right? Like you go there, but it's okay to build a venture career outside of being full-time San Francisco. It's okay to build a venture career anywhere. Like I find that location debates on Twitter to be fun because they get a ton of engagement, but like it's a little bit overemphasized. And so I would just encourage people to like do what makes them most productive and most happy. And generally, like that will lead to pretty good results. And happy that you're part of the LA ecosystem.
Thank you. And we do love the debate, no matter what.
Oh yeah, it's fun.
Super fun. Well, Jeff, it was a pleasure to have you on. I had so much fun talking about everything emerging managers, the piece that you're writing, as well as a little bit of an inside look onto Chapter 1's product strategy. It was so much fun.
Yeah, thank you so much.